Hi, today I will be explaining what a mortgage is and how to take advantage of it. So, what is a mortgage? Mortgage is a form of leverage that you can use to buy a house or any form of real estate. I promise to try break down every technical word. Think of leverage as a form of support that can enhance or fast-track your goals. So how is mortgage a leverage? Imagine yourself as Miriam for the purpose of this video. Miriam is a cashier at a retail store and earns a wage of $15 per hour. Currently living in a rented apartment with a monthly rent of $1,400. That means Miriam will be making $600 per week before tax. Now let's examine financials. Weekly income is $600. Weekly transportation cost is $50. Weekly food cost is $100. Weekly wardrobe cost is $100. Weekly accommodation cost is $100. After every statutory deductions and after all expenses, let us say Miriam is able to save an average amount of $100. Meanwhile, Miriam loves a Western-style house that is priced at $285,000. So for Miriam to be able to buy her desired house and pay cash, she will need to save consistently for 48 years, assuming that the $285,000 worth of house now will not worth $1 million then. 48 years is a long time. But she has another option. She can however simply save for 2 years to save the sum of $10,400. And then use the saved $10,400 as initial payment to get a loan from a mortgage lender. The initial payment of $10,400 is called a down payment. If her loan is approved, Miriam can start living in her dream house from year 2 of saving. Yeah, that is the power of leverage. Using a tool to achieve your goals faster. And in this case, it is using mortgage loan to get your dream house. So what is the process of getting a mortgage loan? Think of a lender as someone with access to so much money and looking for ways to make this money earn more money for him. But he wants to be assured that the money he is about to give you is repaid promptly with extra due to him for helping you pay for owning your house. The money he loan you is termed principal, the extra he is earning on top is termed interest. A mortgage lender can be a commercial bank, credit union, mortgage institution, or mortgage brokers. The mortgage lender may likely tell you to spread the payback over 30 years or 15 years. The spreading of the payback is called amortization. Don't forget that the lender will be adding an interest to Miriam's payback. And I will be explaining how lenders determine their interest rate in another video. Before Miriam's loan can be approved, the lender will usually evaluate her request to be sure that Miriam will definitely be able to pay back the loan and the agreed interest. The evaluation usually consider what is termed 4C of credit. They are capacity, capital, collateral, and credit history. 1. Capacity means that Miriam have the ability to repay back the loan. Recall that Miriam is a cashier at a retail. The lender will like to verify that she is truly working at the retail store and for how long. They will consider her job history for at least the past 2 years. The reason is to ascertain that Miriam can consistently hold on to a source of income that can generate the payback. Imagine if Miriam loses her job and possibly couldn't get a job for say 5 months. That means she will be unable to pay back her mortgage for the 6 months of zero income. This scenarios every lenders want to avoid. 2. Collateral. Whenever anyone is applying for a loan, he or she must present an asset of about the same value, or more of the amount that he or she is requesting as a pledge to be forfeited if she is ever unable to repay back the loan. This pledge is termed collateral. A collateral may be your car, your jewelry. For our Miriam mortgage loan scenario, Miriam will be presenting the house she is buying as the collateral. So for the house to qualify as collateral, it must have the same value or more of the requested amount. The lender will contract an appraiser to assess the true value of the property by conducting what termed is an appraisal. The appraisal report is expected to qualify the collateral. 3. Capital. The lender is obliged to review your finance to evaluate the cash you are bring to the table as down payment and also see how you normally manage money in case of an unexpected event like loss of job. The down payment you will be paying will be determined by the type of loan program that you are applying for. The loan program can be conventional loan, FHA loan, USDA loan, VA loan. Check out my other video for explanation of the different types of loan program on this channel. Anyway, your down payment can be anywhere from 3% of the purchase price. So for Miriam $285,000 house, a 3% down payment will be equal to $8,550. Beside the down payment, you will also need to make provisions for the payment of what is called closing cost. The closing cost include the loan transaction cost like origination fee, appraisal fee, title insurance, property tax, attorney fees, and private mortgage insurance. Thank you for watching. My name is Hayer Hoy Iba Day. And please like this video and subscribe to this channel.